I think we should be proud, but it's not one we should be too proud about, is that we have won Distinguished Taxpayer Awards. Now, what does that mean? You may have seen in the news that we've got waivers on taxes and all that stuff that you see in the news. The reality is we are fully tax compliant, and we have been awarded Distinguished Taxpayer Awards because of the fact that we ensure that we do our duty to society. No presentation can be complete without talking about the current environment that we're operating in. Therefore, let me just quickly say that we are living in unprecedented times. That's an often overused term. But if you look at where we are at the beginning of a growing global recession. People have thought there will in fact be a depression, and all that is dependent on how governments respond. I think the response we have seen so far tell us that it will be a global recession, but a deep recession. In Kenya, our view is that we're going to go through a recession that was last seen in 1970. Now, I look back what happened in 1970, and what happened in 1970, we had some serious coffee smuggling issues, and then there was some deep oil shocks in 1970. Now, the recovery was quick. And the reason people are not thinking this will be a depression is they do think the recovery might actually be quite quick because the world potential is very, very large. So if we look at the countries where we operate in, if you look at Kenya, for example, the GDP growth estimates have ranged anywhere from 0.2, which is our current projection, to 2.3. I think the CBK came up with a projection of 2.3% GDP growth against what they had announced at the beginning of the year, which was 6.2%. So you can already see that there'll be major contraction. In Uganda, the GDP is estimated to grow at 2.3%. Again, I think that is a very optimistic outlook. We think it will be a lot worse than that. But all this depends on the measures the governments continue to take to cushion the economy. And when the economy comes back, how quickly and how connected the world remains. GDP for Rwanda, for Tanzania, sorry, where we also operate, a bit more optimistic at 3.5%. I would hasten to add that, as you know, the information coming from Tanzania is a bit incomplete. We don't know for sure the extent to which COVID-19 has devastated either lives or the economy. And then Rwanda estimated to grow at 3.1%. Now, that sounds good. But remember, the estimate before was 7.8. So again, major contraction expected in that area. For ourselves, as NCBA, we have taken up this crisis and come up with principles of how to manage it. We set up a crisis management team, and the response principles they are followed are three. One, that this crisis, the first response and the major priority must be the health and safety of our employees and customers. And to that, we have done a number of things that we'll talk about in a second. Two, we will actively monitor the risks to the bank and act swiftly to address them. We have spent a lot of time going through all the risks, whether that be people risks, liquidity risks, credit risks, operational risks. We have gone through each of these risks and come up with a way to ensure that we are responding to them swiftly. And you will see our numbers speaking to that exact point. Number three is that it's important to communicate. Daily, there's an email that goes to our staff talking about the actions we're taking, giving them advice of how to protect themselves, and telling them other things that we're doing with our customers and beyond. We have laid out a 6-point action plan. As I said, 1, to protect health and safety. Number 2, to stabilize our operations. Number 3, guard against shocks that we expect to our balance sheets, to our P&L. Take out costs. A lot of work has gone into that. Defending revenue and preparing for post-crisis. If we look at each of these, we have spent a lot of time on 1, 2, through to 4. A lot of work has gone into that. Number 5 is now work in progress. And for number 6, we're forming a team to be focused solely on what happens post-crisis and how do we get back to executing on our strategy and taking advantage of opportunities. I believe a number of opportunities will come up, and we will work together to ensure that that we take advantage of those opportunities. So in terms of the support to our employees and customers, just very quickly, we've done a lot of work, as I've said. I think the only thing I like to highlight on our employees that is unique to NCBA is we gave a one-time compassionate pay to all our employees. That was unique. We feel the need to support our employees. And in April, we made a compassionate pay to our employees that was additional to their regular pay. For our customers, so far we have approved restructurings worth about 30 billion shillings. We're getting a lot of requests. We continue to get a lot of requests. And those restructures range from extension of loans, and a lot of them ask for moratoriums. Luckily, our liquidity remains very high, so we are able to accommodate these requests for moratoriums. Finally, for community, you may have seen the announcement. We announced that we're contributing 100 million shillings to the COVID-19 Emergency Response Fund that was established by the President. So that is what we have done so far as far as COVID-19 is concerned, or as far as strategy is concerned, what we plan to do. There is a short-term strategy, the action points that I've talked about, that's the short-term strategy, but we remain truly focused on the long-term strategy. And we will spend a bit of time now going through our financials, and I shall ask our Executive Director for Finance, David Abwoga, to take us through our numbers. Thank you.
Thank you, John. I hope you can hear me clearly. Thank you. Good morning, all. I think as John said, this is indeed an unprecedented period for all of us. And we certainly do appreciate all the participants who have called in today. Normally, this would have been a face-to-face conversation where you're able to see the person on the other end. We had intended, I think, at the end of the year to have a conversation around our full year performance, but then that was just at the height of this pandemic, and then that disruption really set us off from what our plans were. But I just wanted to mention one thing, and probably to echo what John said regarding the slowdown in economic activity and disruptions that we have seen. I mean, several measures that the government has put, whether it is cessation of movement, the curfew, encouraging, just practice of social distancing. And we've seen that starting in the late half of March, even though banking is an essential service and was sort of exempted from a number of these measures, we continue to experience the impact in one way or another. And as John mentioned, it's either through our staff or through our customers. Now, our quarter performance has had, I would say, maybe 2 to 3 weeks of what I would call the COVID-19 impact. And as I cover the Q1 financial performance, I'll try and give some insights on the recent actions that have been taken to just address this impact on our business. We're definitely in a new paradigm. A good number of our staff are working from home. I think it's a new approach to customer management. There's a refocus on risk and controls for the business. And whereas our financial performance has been strong in the quarter, I think, and John did talk about this, it's important that we really take quick actions to strengthen that performance and set a base for long-term growth from our commitment to our shareholders and our customers. I think turning to, I believe it's slide 21, I thought it's just important to sort of highlight the basis of our financial reporting. And this applies both to this quarter's financial performance as well as the full year results that we released sometime in March. The amalgamation of our businesses did take place on 1st October of 2019. And what happened then is that there was a transfer of business and net assets from NIC Bank then to CBA, which was a surviving entity. The financial statements that then we prepared based on the required accounting standards at full year were a representation of what was CBA for 9 months and then NCBA for 3 months. So you had 9 months CBA and NCBA for 3 months. Now, Q1 2020 financial statements is the second quarter that we've operated as a merged entity. And so these financial statements represent NCBA, the merged entity. However, the 2019 comparative is that of what was CBA. And this is in accordance with the accounting standards on business combinations. And I thought it's just important to highlight, because a lot of you may have questions about what does 2019 represent? Is it a retrospective perspective of the performance of the two institutions? However, the answer is no. We approach this from a prospective basis, a continuation of the surviving entity, and that's what you see in the subsequent slides. And for that reason, really, a lot of the conversation will be around what is our Q4 performance compared to our Q1 in 2020, as opposed to taking a historical view of looking at what Q1 2019 was, because that would not be representative of then what is our combined business. I think I'll then move to the next slide, which is slide 22. This, you can see from both the bank and the group balance sheet is that overall, compared to full year 2019, the balance sheet expanded by about 15 billion shillings, driven principally by an increase in the customer deposit base. And the deposit growth was in excess of what was required to fund our loan growth. And that excess was then invested primarily in cash and cash equivalents, and also in government securities. I can say that looking at that growth and that size and strength of our balance sheet at 510 billion for the group, we are indeed very well positioned to deliver on our strategy and gain market share. With a shareholder equity of 69 billion for the group, this is very stable compared to where we were at full year. And we were able to then invest that growth in deposits, as I said, in some government securities and other cash holdings. We have also continued, because of this good liquidity, as John mentioned, to support the interbank market by availing this to other players in the market who may need liquidity as part of our strategy. I think I will cover a lot of some of the components on the balance sheet as we go along in subsequent slides. I think if I turn to slide number 24, I think what I would highlight here is that you can see that our lending business is stable. Full year just under 250 billion from a net loans and advances perspective. And we obviously do continue. Yeah, the next slide, please. Sorry. We do continue to diversify that lending portfolio. I think when you look at the sectoral diversification, with manufacturing taking the biggest there of 22%, right down to our support to agriculture of just about 1%. So even though the asset book, I would say, has moderated, we did experience a demand. If you consider our exposure to the first level of sectors that were impacted by the crisis, tourism, restaurants, and hotels is pretty low. However, when you look at second level, for example, transport, where we have an exposure of about 12%, then you would expect that downstream there could be an impact of what this pandemic would cause. We've been obviously in this environment cautious in lending, and one may ask, and I'm sure a lot of you have the question of what were our customers borrowing for? What was the demand for in Q1? I would say that we saw a lot of demand towards just sustaining working capital requirements in the quarter. Customers also came for funding to support their capital expenditures, and others were just building their liquidity reserves, as the crisis started to play out. I must say that our relationship managers and obviously the credit team have adopted Pretty First to review new models of how we service our customers, how we employ digital tracking and routing of customer requests, and just improve the overall customer experience. Our loan to deposit ratio, currently at about 70%, really positions us well to capture the demand that we see from our customers going into the future. Client engagement has been difficult in this environment, but has continued. I think we continue to meet the needs of our larger commercial banking customers and our borrowing customers, either as they draw on some of the lines that we have with them, which were not yet drawn down on, or new lines that were made available. Some customers obviously have had new and incremental demand in their businesses. But having said all that, it's important to note that obviously the economic disruption has had an impact on loan origination. We've seen a slowdown in loan origination, and you'll see a bit of that impact in some of our financial parameters. And it has also had an impact as well on new client acquisitions. And those have not, even where we have acquired new clients, there's been challenge in converting those timelessly due to just certain inabilities, for example, to perfect documents. And obviously, as an institution, we are not willing at this time to lower our standards, and would still apply the principles that we set out to apply. From a lending perspective, I would also just mention that we've seen certain products such as credit card balances dip and are much lower. And I think that talks to a lot of us, even on the screen, that there's been a drop, obviously, in consumer spending. And so you'd see that some of those product balances or transaction volumes have actually dropped. I would like to then move on to our loan quality. On the next slide. We've had, traditionally, I think both institutions are very stable non-performing loan ratio. We have indeed taken several steps to enhance our credit quality. You can see that our provision coverage at about 15.5% is very well enhanced, just to make our balance sheet a lot more resilient for any shocks. This coverage ratio and our level of provisioning is actually well above regulatory guidelines or minimums. And I would say that even the residual from what is our gross non-performing loans, if you compare that against the provisions that we hold, the residual is well covered by collateral. However, again, it's important to note that in this environment, recoveries are extremely slow, and our ability to actually deploy collection efforts has indeed been hampered. And that has had quite an impact on the normal recoveries that we'll see from our non-performing loan portfolio. I think John did mention about moratoriums and availing moratoriums to support our customers who have been impacted. We have indeed seen a number of requests for restructure of facilities, whether it's principal and interest repayments, and we have responded to those requests from our customers. So if you look at that, at 275 billion from a gross lending perspective, our gross NPLs were at about 38 billion as at the end of the quarter for the group, which is just about 14%. I know the industry pre-COVID was somewhere closer to 13%, and we are well within that industry average. From a sectoral perspective, and a lot of this is legacy non-performing loans, and as I mentioned, collection efforts continue, but manufacturing and trade really are the key contributors of our exposure to non-performing loans from our portfolio view. Turning to customer deposits, the growth in the quarter and for the group at 391 billion of customer deposits, a 13 billion increase from where we were at full year, I think is a good testimony of the confidence that our customers have, and also talks to our focus on customer retention. we have indeed brought on board quite a number of new liability relationships despite the challenging environment. Not exactly what we had planned for. I think John did mention that we had planned for improving our distribution network through our branch footprint, and some of that has been slightly deferred just because of the current environment. But I must say we continue obviously to be very proud of our staff who have managed customer relationships in this very difficult environment and increased our deposit base. I think our network and our customer experience continue to be a key strength for us as an institution. What we have seen is that there is strength for certain customers, obviously, to keep cash at this time, to continue to maintain strong liquidity. And some of our customers, I would say, are in what I would call epidemic resistant businesses. And we've gone after that liquidity that they have, that excess liquidity, so that we can support them and enables us also to support the rest of the market. I believe this is also a testimony that we are viewed as a safe haven at this particular time. And despite the crisis, that we are able to then attract and grow our deposit base. Our strategy, I think John did talk about it, going into the future, customer acquisition and deposit mobilization will remain a key focus. We will continue to focus on the mix. You can see there at about 53%, our CASA ratio means that we're slowly trying to move away from wholesale deposits, term deposits that are more expensive, short-term in nature, highly volatile, to more stable and sticky deposit base. And I think we are firmly on that journey as depicted by some of the metrics we've put up on the screen. If I move to capital and liquidity, and just talking through select elements of our capital structure, our core capital at about 66 billion is close to 900 basis points above the regulatory minimum. Regulatory minimum is 10.5%. You can see that as at end of the quarter, we're at 18.9%, 840 basis points above regulatory minimum. Upon the merger, our equity actually more than doubled. The first table that you see there, shareholders' equity Q1 2019, represented what was CBA then, and Q1 2020 at just about slightly under 70 billion of shareholders' equity. I think this has provided a very necessary foundation to launch our growth strategy into the future. As many of you are aware, earlier, I think it was late last month, the board did rescind an earlier decision to pay a cash dividend, and instead would be recommending to our shareholders a bonus share issue. And the principal reason for that was really just to conserve capital and also support our various customers and other stakeholders as we go through this crisis. From a liquidity standpoint, I think we've ended up with, I would say, from full year, almost an 18 billion increase, our liquidity at 55%, principally driven by that growth in deposit base, which far exceeded the expansion in our loan portfolio or our other cash needs. And with those kind of levels of liquidity, I think we're very well positioned to deliver on our strategy and deliver value as well to our shareholders. I think let me move away from the balance sheet now and turn to our income statement. I think firstly, I'd just like to draw your attention to the Q1 2020 and where our operating profit stands at about 6.1 billion for the bank and just under 6.4 billion for the group. And this really this illustrates just the earnings power and potential of the group, and also the ability then to support any credit costs that may come up as a result of the downturn that we are seeing. I think we've had a strong quarter despite challenges in the final weeks. It's an extremely good start to the year. Our operating income at 9.6 billion is solid. And to mitigate just what we see as potential risks, we have evaluated various aspects of our operations and developed contingency plans. Whereas our top line performance obviously is strong, and the impact of COVID-19 requires that we take quick actions to strengthen financial performance and growth prospects over the future. Beyond the crisis, we must ask ourselves, what will we look like? And that's part of that growth and just the planning, as John put up in some earlier slides. If I talk through the components of our income statement, our net income at 5 billion for the quarter for the bank and 5.5 billion for the group. This is solid despite what we saw in Q1, changes in the interest rate environment. Most of you are aware that the central bank rate, which is the reference rate, is not about 7%. That has led to some reduction in lending for the facilities that are referenced of the CBR rate. And that has an impact of reducing our interest income. There's continued pressure on the cost of funding. Our strategy is really to tilt our shift of deposits more to sticky deposits, CASA deposits, as a way to the away from the wholesale deposits, which, as I said earlier, are quite expensive. And I think we can see from the earlier slide I put up that we are on that journey. We've heard, I would say, our loan growth has been flat over the quarter. We've then, from the excess deposits that we raised, we've been able to put that excess liquidity in government securities and other investments, which have continued to improve our top line. I think we've seen as well improvements in our NIM. I would say from year end, I think we've seen about 150 bips shift in our NIM. And that really just talks to very swift deposit pricing actions that have been adopted by our ALCO in order to just improve our net interest income. I think future net interest income is really going to be influenced by how interest rates, what the interest rate environment is going to look like, as well as obviously our loan and deposit balances, which I believe are going to be greatly influenced by the environment and the effect that the virus has on our economic activity. If I move to our total non-interest income as a group at 5.4 billion and 4.6 billion for the bank, we've continued growth on our fee and commission income, especially on our digital lending business through increase in volumes. We've seen overall volumes before, and this is pre-COVID, there was increased volumes and throughput. Our FX business has focused on customer retention and volumes in an environment that the spreads are very thin. But we continue to see very granular growth coming from our retail distribution. And obviously the market in Q1 was extremely volatile, especially the latter half of March. But the core focus for our business there is focusing on customer retention and maintaining our volumes. You did see a number of measures that were announced. Our support to some of the government initiatives and the regulatory initiatives on reducing fees on mobile transactions to just enable transfer and enable customers and just the citizens be able to move money around in a much cheaper fashion. And we did lower our fees on mobile transactions to support that initiative. However, I must say that obviously our loan origination has slowed, just given the environment we are in. And that possibly not seen in our Q1 performance, but possibly in the quarters subsequent to this quarter, we would see some reduction in the volume growth of our business. If I look at our operating expenses, we continue to execute on our merger synergies. I think John did talk about our systems, our facilities, our efficiency, be it consolidating some of the systems we have, consolidating our procurement, consolidating our footprint. I think those efficiencies, and in Q1, we've seen some contribution of that synergy onto our expense base. So despite continued increase, in our technology and real estate, we've seen a positive offset by some of the major synergies that we anticipated and we actually set out to execute on. With respect to the pandemic, obviously, again, certain costs have declined. And I would say that is just naturally, if you look at travel or conferencing or any face-to-face type events and activities have declined because of just social distancing and the inability to gather people together. However, we've also had some slight increase in certain costs, which is to protect and support our employees. I did mention that a lot of our employees, for example, are working from home. And for example, we've had to deploy laptops to a large number of our staff to be able to execute their roles from the comfort of their homes. And that comes with incremental security measures, connection to the network, just ensure that that is done in a seamless manner. On staffing and headcount, I think John did mention that we're very stable staff count, 2,700 employees. From a footprint perspective, we did put on hold some of the branch rollouts that we had intended to do. I think if you remember at the pre-merger conversation, we had set out to roll about 15 branches within this year. We've just deferred that for a while as we consolidate the existing footprint and we rationalize what is existing to be able to serve our customers much better. So our cost income ratio at about 37% is extremely impressive. Obviously, we would see some deterioration of that ratio into the future as we continue investments in people, in real estate, and in technology. However, I think we have implemented what I would call short-term cost reduction and cash conservation actions just to protect the bottom line as we wade through this crisis. Moving away from operating profit, I'll just talk very briefly about our loan impairment provisions. And we continue to build our loan loss reserve. You can see for the quarter, the bank at 3.3 billion and 3.7 billion other group is a very deliberate effort to improve the coverage on some of what we see as an unperforming loan portfolio. We still have a portfolio of close to 90%, which is performing, but we continue to just build sufficient reserves and position the balance sheet to be able to take on any shocks that we would anticipate downstream. And that's why you see they are quite a huge, a 3.3 billion provision on our numbers. I think having said all that, our profit before tax for the quarter at 2.8 billion for the bank and 2.6 billion for the group. And then we have some incremental merger-related costs that we show as exceptional items. You recall, again, in previous conversations, we've mentioned that the merger required that obviously we had quite a bit of advisory, whether it's transaction, legal, or regulatory costs that we had to incur, a couple of integration expenses, including development of our brand, and we continue to see some of this in 2020. However, our expectation is that obviously that will be at a much, much lower level than the costs that we incurred for full year 2019. I think I've spoken quite a bit and given you quite some insights into what are the drivers of our balance sheet position, what are the insights into what's driving our income statement, and maybe I'll just pause there, Rosalind, and we'll move on to the next. I can see the slide up, sorry, on regional business. Maybe I'll just touch on this for a minute. I think the message here is that we have presence in Tanzania, Uganda, Rwanda, and the digital business as well, presence in Ivory Coast. Our strategic thrust is really to get to a level where regional businesses contribute at least about 5% from all parameters, whether it is on the gross lending, deposits, and even profitability. I think you can see that from their contribution to gross loans and deposits, they are within that target range. Through the efforts and the integration that's currently going on to bring our businesses together in those markets, I think we will be positioned and will be a much more significant player in those markets to be able to start taking advantage of some of the business opportunity there and grow our market share, and hence have the same kind of contribution to our income statement. Thank you all for listening. I think I would pause there.
Thank you. Thank you very much, David. I think that's pretty comprehensive. I've seen a few questions coming through, which we shall try to answer. But just the key takeaways, I hope, for this morning is that our merger has unlocked a number of synergies. We've talked about them. You've seen from the numbers. Obviously, the focus will probably be on PBT. But you notice the PBT, the biggest thing that affected PBT was NPLs. These are the legacy accounts which we're dealing with, and we continue to provide for quarter after quarter. We also talked about the NPLs from the digital bank because of a one-off bump in limits that we did in October, and that has taken time to work itself through the system. So we have seen quite a bit of NPLs coming from there. I think the other point to note is we have a very clear strategy to drive growth across the region. This strategy will be executed. Obviously, right now, we are focused on surviving COVID. But once we go past this, the strategy is clear to drive our growth. Lastly, that even during COVID, we remain very focused on the long term. We remain very focused on delivering shareholder returns. I have seen questions talking about investments in the future. I would say that the short-term plan is driven by the demand that we see from our customers. And in our press release that went out this morning, I talked about the fact that we have seen a very highly reduced demand from customers. Transaction volumes have gone down significantly. Lending or capital expenditure has dropped dramatically. So what we are seeing is demand for working capital as opposed to capital expenditure. And therefore, we don't expect that we'll see a lot of loan growth for the rest of this year. That said, our deposits have grown strongly. They continue to grow strongly. Therefore, we shall continue to put our money where it's possible and where it's low risk, as in government paper. And I think David talked about the fact that we're very active on the interbank market, ensuring there's liquidity in the banking system, therefore lending to other banks very actively. So that is what I want to leave you with. And now we can open it for questions.
Okay, so thank you so much, John, for those who joined the call as it was happening. John Gashora, our Group Managing Director. And thank you to David Abwoga, our Executive Director, Finance. We have about probably 6 questions. I just want to ask everyone to please post your questions on the Q&A tab. But to kick us off, there is a question here regarding the status of our legacy NPLs that sat on the NIC books prior to the merger, and particularly, between the period of 2015 to 2016. I know, David, you touched on the NPLs, but perhaps you could just sort of shed some more light.
Thank you, Rosalind. I think I touched on it and did mention that one of the things that we have seen even as we continue recovery efforts is that recoveries are indeed very, very slow. A lot of that legacy non-performing loan portfolio is either subject to a court process, and we have to play out the court process just to ensure that we see it through to the end. We do believe that at the end, there will be recovery for the bank because a lot of it was well collateralized, unsecured. However, we must just, go through that motion of getting the resolution done. It is slow, it is painful, and so obviously we've not been able to see that recovery come back onto our income statement as sooner that we had expected for. But having said that, obviously, a lot of that legacy portfolio is provisioned adequately, and we feel comfortable on the levels of provisioning for that portfolio.
Okay. And I think, David, this one could possibly be for you again. Given the lack of a proper base period comparison, please give us the cost of risk for Q1 2020 versus full year 2019.
Again, as I said, the full year 19 basis was obviously not exactly comparable because your base will be different. I think when we look at cost of risk, we try to separate that between what is our digital part of the business, which you'll not be looking at what are you closing with from a loans and advances perspective and what's your impairment compared to that, but rather you'll be looking at what is the churn and the volume of churn of that level of business vis-a-vis the impairments relating to that. So for full year 19, as I said, given that base, and I think the person who's asked the question has recognized that obviously the base is not comparable and so difficult to say that. I would just like to put the impairment provision in a bit of perspective so that I think you look at it from sort of three perspectives. One, obviously, the state of today, we've got quite a large component out as digital loans to our customers in that segment. If we talk about disbursements for the quarter in that segment, is well over 100 billion from a child perspective. Now 100 billion, and if you look at the contributor of the impairment there is probably just slightly over half the impairment provision that you've seen of 3.3 billion, about half of that. Now that is a very low cost of risk when you consider that to the overall churn. I think secondly, we did mention that we have actually enhanced our provisioning to improve our coverage, partly because one, obviously with COVID and anticipated disruptions, we've continued to build our reserves. But secondly, also because as we go along, you find that customers with challenges fall back on their payments, and we have continued to be, I would say, sort of aggressive in terms of taking provisions to cover any potential delinquencies. So I may not be able to sort of give a full year view because there's sort of a mixed bag in there from what that provision number represents.
Okay. John, you referred to one of our sweet spot segments as asset financing, and there's a question here regarding the extent to which this segment has been affected by the pandemic, and what actions are we taking or what strategies are we taking to continue protecting this segment of our business?
Sure, I think the there has been two ways in which it has been affected. I think it's one is good to say that the way we look at our asset finance business is there's a portion of it that's corporate business, and there's a portion of it that's a retail business. Retail business are the regular owner vehicles or owner operated trucks. And then you have the corporate business, which is much larger long haul trucks. The long haul truck business, I think there's no guessing that it has had some problems for quite some time. Some of it attributable to obviously the SGR coming and taking some of the business away. The stories you've heard about Mombasa and the activities at the port has certainly affected that business. So it's not just COVID. Then they were having some issues even before. So for those, we'd already taken quite a bit of action. And in fact, when you look at the detail of our NPLs, the detail of our provisions, so some of them, quite a bit of it actually relates to those legacy corporate trucking companies. On the other side, you have the smaller owner-operated, short-haul trucks. What we have seen is that a good number of those are in what you call essential businesses or essential services. They're the ones transporting food across the region. And those ones are doing well. And in fact, we have seen quite a bit of demand for that sort of vehicles coming through. On the other hand, there are those who are not in essential services. Those ones that you see bringing sand and other things, which often operate at night, but with the curfew they cannot. So we have seen some stress. And I would say we have seen quite a number of applications for moratorium and extensions in the asset finance business. However, if I look at the drawdowns in that business, which means the monthly disbursements, we had pretty much a record month in March. Before that in February was a bit lower, which tells me that the growth continues. In April, obviously, the numbers have come down slightly, but we have still seen quite a bit of demand. We're just judging by the number of applications we have in the system. We're obviously being very careful. We are relooking at some of the schemes where we were lending up to 95% of the value of the vehicle. That is being relooked at given COVID-19.
Okay, and building from that, John, there are two questions here asking the percent of the loan book that has been restructured.
As I said, we have, as of now, restructured about 30 to 35 billion because we're doing it every day. So if you consider that against a loan book of 230, I think it's easier to get the percentage.
Okay, all right, great. So there is a question here asking, as expected, your bank, like others in the industry, are leaning towards the investments in government securities as a credit risk mitigation strategy. What is the bank's view or opinion with regards to the government's credit worthiness at a time that it appears to be facing difficulty servicing its domestic debt? Does this concern NCBA?
First of all, I don't think it's a fact that the government is facing difficulties servicing domestic debt. I think there is, obviously there has been a lot of media reports talking about the proposed negotiation on interest repayments for pension funds. My conversations with government tell me that it's not that they're having difficulties being able to pay debt, but it is a general liquidity management process. And obviously, given COVID, just as we are doing, just like every other business is doing, they're all looking at ways to manage their liquidity. So I don't think it's difficult. The second thing I would say, and I think it's something people need to bear in mind, is that governments all over the world almost never default on their local currency debt, all over the world. The reason is very simple. They can just print money. It's that simple. So I don't think there is any fear, at least in my mind, that for Kenya shilling denominated debt of the Kenyan government, there is any possibility of default or not being able to pay. That I don't think there is. But obviously, the fear obviously is always that if you print money, then the value of the shilling deteriorates. And that is why the government needs to be actively managing its own liquidity so it doesn't go into that route. So all that I'm saying to explain that we have no fear. We have no fear that investing in Kenyan shilling denominated government debt could default. So we'll continue to make those investments.
Okay, excellent. Another question here, what is the estimated impact of COVID emergency measures, monetary policy easing and restructuring of loans on net interest margins and cost of risk for full year 2020? And it's a three-part question. What portion of the loan book percent is still referenced to CBR in regards to pricing? And lastly, how does NCBA intend to close the gap in return on equity between NCBA and its peers?
Okay, as I always say, we don't give forward-looking projections. I will not be able to give projections for the rest of the year. But safe to say that obviously that we are looking at, press release says that the next 3 quarters will be affected by COVID, and we expect that the cost of risk will go up during that time. But that all depends on the kind of restructures that we do. As I've said before, our restructures are well thought out. We speak with our customers. It's not just make a phone call and you get an extension or get a moratorium. There is engagement to understand how you're going to recover post-COVID. So that gives me a bit of comfort. On the second question, just say the last question again, Rosalind.
How does NCBA intend to close the gap in return on equity between NCBA and its peers?
I think there was another one after that.
Oh, what proportion of the loan book in percent terms is still referenced to CBR in regards to pricing?
Okay, I think on the CBR one, none of our loans now are referenced to CBR. We've moved all our loans to reference the NCBA base rate as of 15th of this month. So we're not exposed to movement in the CBR. It does not mean that if CBR moves, we do not react, we do not change our base rate. At least we do it uniformly across all our customers. As far as the gap between us and our peers, that gap has been there even before COVID. And that's why we spend time talking about the strategy that we are pursuing to lower the cost of deposit. That seems to be our biggest gap, is the cost of deposits. And that's why I talked about the retail expansion that that forms part of our strategy going forward.
Okay.
And maybe Rosalind, just to add on to what John has said, when you look at the mix of our loan portfolio, about 35% of our portfolio is foreign currency lending. So the component that is local currencies is about 65%, and that's, I think, the one John has talked to that could had a component that was previously linked to CBR, but now all on NCBA base rate.
Okay. There are 2 questions here alluding to our borrowing appetite. Sorry, I just lost the question. Yes, are we willing to take up more risk to lend further in 2020? And someone has also asked around that, how is the bank settling its liquidity in preparation to take up private sector lending?
Sure, maybe I can take that. The first part is about lending. Our current stance is that we are on a very short-term, what I call short-term strategy. And the strategy in the short term is first to support our customers. So today, getting new customers to be approved for lending, I'll be truthful, is difficult because we want to conserve our cash and capital and our liquidity to support customers that have been with us through this journey, because those are the customers we shall need post-COVID. So that is what we are doing. As far as the future, we are at a liquidity of 55%. We continue to watch our liquidity very, very closely, and that's all to plan for the future. So a question about dividends. The reason we reversed our earlier recommendation to offer cash dividends was because our feeling was we give this money to our shareholders at a time when it's probably needed to support our customers. So we reversed that decision to conserve capital, primarily to support our customers. So that's our focus right now. I'll be lying if I told you that we're out there looking for new opportunities of lending.
Okay. Okay, there's a question here regarding the impact of the no charges on bank transfers to mobile on revenues. And do we see the bank maintaining this stance into the second half of the year or reverting back to original costing?
Well, I think David could talk about the amounts, but obviously it has, we're a very digital bank, so we do have a lot of mobile transactions, and therefore the removal of those fees does hurt our bottom line. It may not show as much money because it happened towards the end of March, so the effect on the first quarter numbers may not be significant. It will be significant in the second quarter. On the question of how long this will last, I think when we all started, we all thought this thing is a month. When the president came up with a curfew, he gave 21 days. Well, that 21 days has been extended 2 times already. No one really knows how long this will go for. Our belief and how we are restructuring loans is we are seeing no less than a 6-month period of strain. And if that is the case, then I would suppose that the conversation banks had with the central bank will be reviewed every month and could persist well into the end of this quarter.
Okay.
Yeah, I think, John, you've answered the question in terms of the impact. It's quarter one a bit too soon. Obviously, you would expect that with transaction volumes growing, then one can sort of absorb some of the reduction in the charges. But again, just too soon to see how that will play out to get a real view of what the impact would be.
Okay. Okay, so it's 8:54. We were looking to close at 9, so we will take a few more questions, but it's important to mention this presentation will be made available. It will be uploaded on our website, and we will include an email address where you can continue to send your questions. The entire team is ready to take your questions. But for now, there's a question on the digital bank, and specifically, what is the NPL ratio of the digital bank on average?
David, do you want to take?
Yeah, I think just like I said, to put it in perspective, you've got to look at what is the churn of loans as opposed to what loans are sitting on the balance sheet at any period in time. Close to about 100 billion in disbursements for quarter one. I would put that at somewhere between 2 to 2.5%. That's where that is, yeah.
Okay. And what is the bank's SME loan exposure and how is this performing? Will the bank reduce digital lending in light of recent directives on reporting defaults to CRB?
Maybe I'll take the first question on what's the exposure, and John can take the difficult one. We've got just about at the quarter end, about 33 billion of our lending is to SMEs, and another slightly 42 billion on the retail side. So that puts it at about 13% of our portfolio is our exposure to SME.
I think on the experience on the SME from a COVID perspective, again, we're seeing a lot of requests from the SME sector and from the personal sector asking for relief. And as I said, it's really the job that we're doing to say, is this an essential service or not? There are many things that are going into the calculation to decide whether to give relief or not. But out of that 30 billion that I mentioned, quite a bit of it related to the SME and personal banking sector. On the digital question, our belief, and this is how we approach it, is we're leaders. We're leaders in digital services, in mobile savings and loan, through Mshwari, and of course our job on Fuliza. As leaders, we don't quit. We must continue to support our customers when they need us the most. However, from a risk mitigation perspective, we are looking at our engine, our risk scoring engine. We're looking at our relationship between Fuliza and Shwari and other things that help us risk score our customers correctly, knowing that today we cannot report customers who are borrowing 1,000 or less to CRB. So that's it. We'll continue to lend on our digital services. What we change is a credit scoring process.
Okay. Okay, a question here. When the loan book was moved to the NCBA base rate, did your average loan pricing rise or fall, and by how much? Also, what's happened to the agency network through this period?
I think it was a no option move. In other words, whatever rate you had, that's what you moved with. So it did not move our interests one way or the other. What it does, however, it gives us control of the future. It puts the control of the interest rate into our hands into the future. What was the second question? Sorry.
What's happened to the agency network through this period?
We do not have an agency network per se. So I wouldn't be able to answer that because we do not have one.
Yeah, okay. Is there a possibility of the main shareholders offloading more shares to the public, given the free float is not really significant?
That I don't know. I don't have an answer. I think one of the reasons actually we decided to do a bonus share as opposed to cash dividend was, one of the motivating factors was that we'll be able to increase some of the shares available on the stock exchange. And also, obviously, that gives an incentive to our shareholders to trade some of their shares if they want cash. So we do recognize that we don't have a lot of free float, and we are taking some of those steps.
Okay. Okay, and our last question for this morning, what percentage of the collateral is real estate based? And how much have you accessed from the CBR deduction? And how many loans and in which segments have you restructured as a result of, I suppose, in this period?
Well, on the first one, the percentage of collateral as real estate, I don't have a number. It's very large. I think that is a reality of banking in this country, that a large percentage of your collateral is tangible, which means land and buildings. So we do have a very large exposure to that, and I think that is true for any bank in this country. As far as the CRR is concerned, we took our time before going to access that amount. And the reason, as I said, was because we have very high liquidity. And we were pushing to have a few things modified in how to access that money for the benefit of other banks. I see it as the vice chair of KBA. So I look at it from a bank sector perspective, not from just NCBA perspective. That said, I think the numbers are easier to calculate because the CRR requirement, 1% reduction of our deposits, that comes to about 3 billion, I believe. So that's the amount of money that we have available through the CRR reduction. I think that's direct math.
Okay.
Yes.
Okay. So it's 9 a.m. John, I don't know if you have any parting remarks, but I think for now it's just to say thank you very much for your attendance. Thank you, John and David, for the presentation. Again, it will be uploaded immediately on our website, and there you will also find our press release and the financial results themselves. So perhaps just a parting shot from you, John, and we will call it a morning.
Look, it's really just to ask everybody to stay healthy and safe. This is the time to care about your family, and this is the time to watch carefully those banks that are well governed like ourselves. But remember, that the next 3 quarters would be a super ride. Thank you.
Okay. So that's the end. Thank you again and have a wonderful day.
Thank you.
Goodbye.
Thank you. Bye-bye.
Good day.